I'm John Gilmovich from Real Property Manager.
Hi, I'm Debra from the Property Frontline.
And I'm Ken from Avvora Finance. Thanks for joining us today in this session of our episode of Property Mythbusters, where we normally go through the myths surrounding property investing. But today we're just giving a quick unfiltered update in terms of what's happening in the market out there. I guess there's a lot of uncertainty. It's just good to get a feel for what's happening out there in the market specific to property. So for in terms of credit, it's quite interesting. I think the notion that lenders it's hard to get a loan in this environment is probably more so. It depends on your situation. So it's not entirely a general blanket statement that it's just harder to get funding. So if you're not on the government subsidy, the JobKeeper payments, and your hours haven't changed, you'll find that generally speaking, there isn't too much in the way of additional documents that you need to support your application. If you are on JobKeeper or you're running your own business, you'll probably find that you just need to provide a little bit more documentation. If you're applying, I don't think there's too much in the way that you'll need to do yourself, just apart from providing information. But there's a lot of changes from a broker's perspective. There's been a lot of changes in terms of calculations. Do they use the JobKeeper amount? To what point do they use your original pay? There's also a lot of tightening in the, a tightening in the amount of information that the lenders want for borrowers. They are being a little bit more risk adverse at this point in time. And one thing that I probably wanted to share as well is just that the demand for home loans has skewed towards refinancing. I think there has been some long-term trends or graphs from the RBA that we've kind of seen kind of show that. But what we can see here is, so this is just on the monthly basis, what the loan purpose was. So draw your attention to the refinancing. So 65.16%, almost 2/3 of loan activity is refinancing. So if you haven't reviewed your loans in the last 2 years or so, 2-3 years, now's a good time to kind of check out where your interest rates sit. If there's anything that you need to do with your funding, whether there's any cash out components or anything like that, now might be a good time to just have a quick look over your home loan structure and see if it's still relevant to your current circumstances. And yeah, there are still a number of people purchasing. A quarter of people are still out there kind of purchasing. So just as a rough overview, that's happening in terms of the changes. There have been so there's still a strong demand for credit from the credit perspective. So that's basically what's happening out there from the credit perspective.
What's still pretty active then?
Yeah, it's still very, very active. Especially with the refinancing, and I think the majors are finding that they're seeing a lot more applicants flow towards them just in uncertain times. There's that security knowing and the brand and the trust that kind of comes from the established lenders there. So people are moving towards them, and that's kind of had this flow-on effect with their servicing levels and things like that.
So do you think people are moving from the smaller non-banks towards the bigger banks?
Yeah, they are.
Because they're offering better deals. Is that right, or why?
So not so much the better deals. There was a point in time where we kind of saw some of the majors basically beat, from a price perspective, some of the small lenders in fixed rates. Since then, that's kind of normalized, and it's kind of back to the typical. You pay a little bit more with the major lenders. I think it's just knowing or having that sense of comfort that lenders, been around for a long time.
Despite all the corruption.
Yeah, I think it's
short
just
memories.
Yeah, so I think it's just it's an interesting behavioral trait that, you know, like there's a lot of uncertainty in terms of economy, employment, things like that. So having one less thing to worry about, which is your lender and whether, you know, what's going to happen with that lender, what are they going to do with interest rates and things like that. I think there's that move towards the major lenders. There are still, I'm finding most of my clients are skewing towards the majors. That's just what.
And are you finding people like your buyers, or you know, people who are coming to you for loans, are they confident or?
Yeah, so contradictory to what the data was showing, which is like 2/3 refinancing. Like my clients are basically purchasers. For the reason. So I'm not really seeing the.
I love the refinancing.
Yeah,
that's good.
The same sample size as what everyone else is going through. But the purchasers that are coming to me are confident in terms of what's happening. I think there's a sense of, you know, now there's a lot of uncertainty. So there's two minds of thought from what I can tell. When there's uncertainty, some people will kind of go in to see if there's any opportunities, because the majority of people are probably playing it safe. And then the other side of the fence is, no, we're not going to do anything. It's too risky right now. We'll just wait until, you know, things kind of normalize or settle down, or post-pandemic, and then kind of make a move, which is what I saw like at the start of the year when, you know, people would kind of, there were a couple of clients who that were you know, going through the process, and then they just basically, they weren't sitting on the fence. There was either, yep, let's do it, or nope, I'm postponing.
Okay.
Isn't it interesting that you mentioned that, Ken, that you know, people are saying, well, I'll do something when things get back to normal. That word normal, you know, it's getting thrown around like a football, and it's always a good reason to you know, put things off. I don't know what normal is going to look like. No, I don't think anybody does.
No.
But certainly
Donald Trump does.
we can't see obviously with what's happening locally and around the world that anything's going to be back to normal anytime soon. This is the market, and we're playing now in this market, and that's it. That's it.
Yeah, I agree. Like it just seems, and I think that's where some of the clients who did postpone have come back as well. And they're, you know, ready to kind of, like, they kind of feel like this is the new normal, I guess, and moving forward from that, what they can do. So there's a lot of things still happening and changing, but there's a lot of credit policies, and lenders are kind of adapting their credit policy to suit this kind of protracted scenario where, you know, the pandemic continues and it's kind of like the new normal. There's a lot of stuff happening in the background, but they still are lending. And I think there was one article, the RBA was, or one of the government bodies was saying to, you know, not restrict the flow of credit, but still be responsible in lending.
Okay, that's good. And so, John, what's happening in your space? Sorry to cut you off, Ken.
That's right.
But I was cutting you off.
Well done, Ken. So the rental market, well, you know, since a fortnight ago, not much has happened, Deborah, on that front. Still not terrific news for, you know, property investors, the landlords out there, with, you know, continuing downward pressure on the rental markets in the inner city markets, or the in the metro markets. We'll take a look at the stark contrast between the inner cities and the regionals in a sec, but bottom line, the inner city continues in a high vacancy. So we're sitting around the 3.5% mark vacancy rate right now in the inner city markets.
That's actually good compared to what it was.
Yeah, so there are pockets of, for example, Sydney that are high in vacancy rates, such as the more saturated apartment markets, such as Pyrmont, the CBD, things like Alexandria, Mascot, Rosebery, those high density areas. I'm seeing some pretty dramatic rent falls going on.
All right, that's
15, 20%. Yeah, 15, 20%, Deborah, is now the normal.
Wow.
From last year, where rents are coming off. And yeah, tenants have just got this amazing bargaining power right now. What I'm seeing at the open homes, pretty straightforward, is that they're walking through having a look. And for many years, I haven't heard that sort of language, but dialect, but basically, will the landlord take an offer is pretty much the first thing that comes off the top of the tongue. So they know that the market's volatile. They know that landlords can hurt with high vacancies, and basically the stock choice is pretty far and wide. So definitely tenants are taking advantage of that. So let's have a look at activity, Deborah, from the REA. So nationally, as you can see, the volumes.
No, we can't see.
Oh, can you see that? No. I've gone to the document, but I haven't shared it.
Yeah, so just go down to the bottom of your screen and press that green button.
Okay, here it is here.
Yeah.
The market update. Beautiful.
Yeah.
The volumes have risen slightly, 0.7 over the last few weeks.
Volumes of
rental property.
Oh, okay, yeah. So properties available for rent.
That's correct. So the stock levels have risen from a national perspective, as expected.
I would have thought it would have been bigger than that, but that's good.
Yes, but you can see searches are up. So people are looking, people are browsing, prospective tenants are researching. Because yes, the opportunity is there to move right now and pick up, or upsize or upgrade, or at a much better rate than it was last year or a few years back.
So removalists must be the winners from COVID then?
Well, yes, anyone involved in relocations process is a winner. Utility companies as well come to mind. So electricity is on and off. One of the things we support at Real Property Managers, utility connections, and there's higher activities with people moving around. And transferring across. So 40% higher searches this time last year. But the bleak situation with the overall market here, as is in this article from the Daily Telegraph, is it's a bit of desperate times for some landlords, where now incentives are being offered to grab tenants' attention and compete with offerings such as free Netflix and free rent, so free rental periods to get tenants in and get them in sooner.
But this would be mainly, like, more competition is with units, isn't it? Rather than.
That's correct. So the hardest hit is the apartment markets, the strata apartments.
Yeah.
Rather than the established homes.
Yeah.
So the ones that are most affected is generally the strata apartments. So as you can see there, unprecedented levels of rental properties, 27,000 across Sydney in the market, and perks are being offered online to attract and compete. It's basically investor versus investor at the moment, with the limited pool of tenants that are available. I mean, Sydney and Melbourne, and of course Queensland as well, the East Coast, generally attracts high, in particular Sydney and Melbourne, attracts high level of immigration and intake. and that's just not there. You know, it's just not there. So you've got this high level of stock just available and not being able to let. So
tricky times.
Yeah, and in particular the CBD recording.
Sorry, Ken, what was that?
Yeah, I do have a question, John. So how, like, given the current market, how are landlords kind of, what are some of the things that landlords are saying about the situation? Are they kind of just like
Crying?
That's just how it is? Yeah.
They're not at that crying point if they're realistic and do something immediately and not dream or hope that a tenant's going to come along and pay them last year's rental prices.
Yeah.
Right.
So we've got this kind of group that, you know, it takes them maybe 2 to 3 weeks to adjust and realise that, you know, last year's rent is just not going to occur. Yep. And you've got those ones that are immediately taking action and reducing the rent to compete. So they're out there doing the research, they go online, have a look at the portals, you know, the rental listings, and all of a sudden realise, yep, you know what, when similar 2-bedroom, 2-bathroom, 1-car space apartments are being offered 60, 70, up to $100 a week less than mine, I obviously need to do something right now or face potential vacancy.
Yeah. Would you say it's the majority or minority that's kind of hopped on board and just adjusted their pricing? Would you say, like, are they just?
Yeah, I'd say the majority are realistic. They've come to terms now, you know, since, you know, since March when COVID hit, we've come to realise and come to terms with, you know, all that's information that's out there about the rental marketplace, that it's not yesterday's market anymore. And they have to adjust, otherwise they're going to have cash flow issues, and cash flow issues leading to hard decisions if they can't get a tenant in the property. Because as we know, most mum and dad type landlords are very high leveraged on their investment properties. You know, some of those are negatively geared, of course. So it's hurting them when they have to, you know, go deeper in their pockets and pay the difference each month.
Yeah.
Mortgages are due, council rates are due, strata levies are due, maintenance has to be done. All those things continue, and zero income, you can't sustain that long term. So, the market kind of rebalances things very, very quickly. Yeah. And they make the hard and fast decisions to reduce or offer incentives, or they will need to sell out. I've had clients put their properties on the market, a couple of them, particularly the hardest hit sort of Sydney areas, because they're just not able to hold the property any longer.
I guess just thinking out loud, I guess it could help if they were to sell it and their pricing is within that first home buyers. There seems to be a strong demand for, you know, first home buyers, the owner occupied.
Yeah, definitely.
So, all right.
Yeah.
So you can see the yields up to June 2020. You can see there the difference between the units and the houses. So interestingly enough, the apartment market in the inner cities have been yielding better than the homes, than the actual established houses, and that's obviously because of the purchase price differential. So from a yield perspective, the apartments have been performing generally better than the established houses overall, and that's because the last few years there's been terrific, you know, rental demand in apartment living. And going into the regionals. So as you can see there, that's the ANZ Housing Affordability Report that you just saw. Units are delivering a high yield in houses. So if you're looking for better yields, the apartments are the way to go.
Yeah.
So vacancy rates, have a look at the regional markets. Well, there's your Blue Mountains. It's hovering around, just under 1.5%, heading lower. Look at the trend. Look at the trend there at the end of the graph. So
people are moving out.
People are moving further out. This is what's happening, Deborah. People are moving further out to more affordable pockets. And given that work from home is now the normal, well, they're able to do that. So they're able to move out into the suburbs at cheaper rents and still be able to earn their incomes that they've actually earned previously, and living in more affluent, expensive areas for convenience of travel, and able to flip that around where they're living in the outer suburbs, price of living is less, but their income remains. So that's a win-win.
Yeah.
And hence the popularity of now heading out to the regional areas, their Central Coast. So you can see, again, downward trend on the vacancy rates. Vacancy rates are falling.
Yeah.
Wollongong heading towards 1.2%. That's pretty low, Deborah.
That's really low.
That's demand starting to exceed supply in those areas, where in the inner city it's the reverse. We've got oversupply and less demand. So
we should start to see rents harden in those areas. Rents going up in those areas. Yeah.
Yeah. So this is Victoria on the Mornington Peninsula. So the graph's starting to fall there just at the end. I don't know if you can see my mouse hovering around.
Yeah, I can. Yeah.
Yeah. You can see a downward trend starting to fall. It was up around 4.5%, heading towards 3%. Mornington Peninsula been in a downward trend as well, heading towards 1% vacancy. So there's demand there in the regionals.
Even in Beenleigh. Okay.
Yeah, so you can see the pattern. Here we are in Queensland, Ipswich, heading towards 1%. Northern Brisbane, Caboolture.
And is that for houses and units? Must be the combined.
Yeah, that's combined dwellings.
Okay, alrighty.
And here's the summary and the contrast between the CBDs versus the regionals, where the CBDs are an all-time high vacancy rate.
Yeah. Summing it up nicely there. Summing it up nicely there. Still an ugly situation.
We've got a fundamental shift in thinking and living and lifestyles going on right now in the rental market, where tenants are starting to realise, well, you know what? We could be paying less rent, living further out, and we still can run a business and still be employed without the travel.
Yeah.
And the inconvenience. So the outer suburbs, look out, because that seems to be where the renters are heading, out of the cities, out of the CBDs, and out to the regionals, as it seems, Deborah.
Yeah. Okay. All right. Well, thanks for that, John.
Thanks, John.
So let me just get the screen back. Alrighty.
We've got a trend. We've got a trend here now.
Yeah.
New trend.
Yeah, and it'd be interesting to see how long that actually lasts.
Yeah, and will there be a push for investing in those areas? Will the investors start to drift away from the hopes of capital gains and into yields, back into yields?
Yeah. Well, only time will tell. Okay, so Yeah, so from my perspective, we are also starting to see a trend of people wanting to move their home base. So we're starting to particularly hear about people in Victoria, specifically Melbourne, wanting to sell up and move to Queensland. So we'll see how that actually goes, because they're all locked down there for a little while longer. But setting aside the purchasing locations, the general trend after a burst of excitement and positivity, we're now starting to see demand for or buying intentions starting to decline a little bit. So this is a graph produced by realestate.com, and it's based on the activity on their site for people showing buying intentions. Now this is from the same organisation, and this has been a graph that really has been telling a very specific and clear story of what's actually happening in relation to searches. So you can see here, people who've been watching us know that we've been commenting about this graph for a while, but this actually shows, and can you see my cursor?
Yes.
So you can see here, this is when the initial lockdown happened, and everyone pretty much just stopped searching, probably because they were in survival mode, queuing up in the grocery stores. But that quickly rebounded. So that was within 2 to 3 weeks, quickly rebounded and then soared straight up. Remember that in March, before everything was locked down, the market was really starting to heat up. People were paying ridiculous amounts of money month on month, and there was going to have to be something done by the government to cool it down again. But, we had our virus crisis and that all stopped. But that has really rebounded, reached a peak right up until the Victorian lockdown and second Victorian lockdown, and so now that's really starting to drop. So search activity, which you could correlate with confidence and buying intention, so that's starting to soften, but it's still higher than it was when the market was super hot in March. So there's still a lot of buyers who missed out, and as long as their financial situation hasn't changed too much, there's still people there who are really keen to actually buy soon. Oh, and the other thing to comment about this drop is that this is the national graph, and so the majority of the downturn actually comes from Victoria, whereas the other states only dropped off by about 1%. We see a similar picture for commercial, though the variance, it looks dramatic, but the amount of percentage change isn't as much, but still a downward trend there. And then in relation to supply and demand, so we are starting to see stock levels come up a little bit. This is just auction listings, and of course the number of auctions that people are holding at the moment is down, so it's not an indication of the entire stock level, but there is a bit of a trend where normally we would see these numbers up close to 1,000 at this time, and then clearance rates, which can can be fudged depending on the way the numbers are reported, but this is data drawn from SQM, so we know they're impartial and we're getting the real numbers. And so Sydney, after last weekend, was 48%, Melbourne 45%. Now, when you get to around about 40%, you'd say that you're in a buyer's market. Anything above that is really more on the sellers. The sellers got a little bit more power. Yeah, so basically, as Louis Christopher from SQM says, we are now starting to see a bit of an orderly decline in prices, not a crash. And so for people who are looking to make really good purchases, as long as your personal situation indicates that you can buy, it's a good time to buy. And the reason for this is that, you know, you're not competing in a market where people are just throwing money at the solution, so you can make good, sensible choices. And the market is a bit subdued, so it means that when you know, we don't know when it will rebound, but when it rebounds, we're expecting it to spring back pretty hot because there's a lot of pent-up demand. So the other thing I wanted to show, because I know we've got to wrap up, is realestate.com is doing some really great things with their reporting at the moment. And I came across this piece of research that they conducted in over a period of time between May and July, where they surveyed 5,000 of their visitors, and they split the responses back into 4 waves. So you could see, as COVID impacted the market, what impact that would have on different buyers. So look at that, isn't that amazing? Anyway, so this shows the split of the different type of people who responded to the survey. This column here is buyers. This column here is renters. And so we can see here that there was still, out of the 5,000, a greater percentage were people who considered themselves to be buyers. There's also a column here who are dreamers. Quick peek at what the buyers, so that big column of buyers, what were they looking to purchase? So 4% a holiday home, 16% an investment property, but the greater majority, which is what we've all been seeing, a greater majority were looking for home purchases. We asked our participants when they thought the market would return to normal, and so what this one tells us is that most people in each section or through each wave, so at each point in time, were expecting that the market would return to normal. What's the definition of normal? We can argue that. That it would take about 12 months. So they were expecting 12 months, it would be around about 12 months before, I guess, prices really started to go crazy again. But that is me just overlaying my perspective on that response. And so, do property owners, the question for this section, do property owners think it's a good time to sell? 20% said yes, 55% said no, 25% said don't know. So most people were saying it wasn't an ideal time to sell.
Quick question with that, Deb. Are you finding, like when you're sourcing properties for clients, are you seeing a decrease in the amount of stock levels and things like that, or options that are available to them, or it just depends on
Absolutely. There is a clear lowered amount of stock on the market. We have heard reports of that really changing over the last week or two. But this perception back here that it's not a good time to sell, from experience, is probably not the right kind of mindset, because good property is still achieving very good prices, and if people are wanting to put their property on the market, so if it's, you know, works for you in your personal situation, it's actually a good time to put your property on the market, because you will have less competition and therefore you'll get a good price. That's for houses, probably not for units.
Yes, so. on the ground, Debra, just in the West Market, you know, where I roam a lot, definitely you can see the for the sold stickers going up very, very quickly.
Yeah.
And definitely a lot of them are getting transacted pre-auction dates. So the agents, you know, also have a dilemma at the moment. They're short on listings. They're looking to make a quick sale, and that's why there's been sort of an escalation of off-market, what they call off-market sales. Maybe we'll discuss that topic real soon about what off-market actually is. But transactions are happening. They're happening quickly, especially with the established properties, the homes. Sold stickers are going up literally within the week of the auction signboards going up.
Yeah. So, and I'm right on the front line with that. Anything that we think is really, you know, a good prospect, we have to move quickly with it, because otherwise we'll miss out. But
it's not going to even make it to the auction date. So
but that, as I said, that's for good property. For units, it's a different kind of situation.
Absolutely, yeah.
And so here's what owners are wary about selling. So this just shows that people have a wide range of views. So some people said they're wary about selling because prices are trending up, and some people said prices are low. But yeah, so big mix of opinions there. I'll just skip through these because I want to get to these last two. So now let's look at whether people think it's a good time to buy. 48% of people said yes, it was a good time to buy, but look at the splits. So the majority of people who think that are either 35 to 49 years of age, or the 50 to 64-year-olds. So a smaller number of the younger group say it's a good time to buy. And
yes, so the Gen Xers and the baby boomers
and the rest, who, as you said, are cashed up.
They're cashed up. Yeah.
Deb, would you say that because we haven't seen as like a crash in the property market, so there's lower stock levels, there's a stronger demand, or there's a majority of people wanting to look at buying property? You reckon that's kind of helping that situation with the way the market's going in terms of prices for property?
And it's a completely the opposite narrative that you're hearing in the media. So you'll hear these headlines, prices are dropping, and then when you look into it, it's like prices have dropped by 0.005%. Of course, that's fine. And also then once you look into that a little bit further, prices really haven't dropped. In some cases for houses, they've increased, but overall, when you mix it all together with houses and units, prices have dropped. But the houses are holding up the overall, while the unit prices are dragging the lot down. But anyway, so that is pretty much us for this week. We have gone over time, which we're really starting to tend to do.
40 minutes now, Deborah. 40-minute mark.
Yeah. I know. Okay, so
there was a lot to cover. It's all important.
That's right, and I was just really enjoying showing those graphs. So thank you very much for watching. You can contact us if you have any topics that you would like us to cover or questions that you have for us as a group, the Property Mythbusters, or as individuals. So John can be contacted at realpropertymanager.com.au. Ken can be contacted at avvora.com.au, or you can reach me through the propertyfrontline.com.au. So thanks for watching. Bye.
Thanks for watching. Bye.